Have you ever wondered how the world economy works? It's a vast and intricate web underpinned by concepts that, while seemingly abstract, have real and tangible impacts on our daily lives. At the heart of this global financial network are 5 key elements: the World Bank, gross domestic product, debt, inflation, and economic growth. Each of these pillars plays a vital role in shaping the world's economic landscape, influencing everything from the price of your morning coffee to the stability of nations. The World Bank, a beacon of international economic cooperation; gross domestic product, the yardstick of a nation's economic health; debt, a double-edged sword of growth and burden; inflation, the silent eroder of your purchasing power; and economic growth, the sought-after goal of every nation. Understanding these concepts is like holding a master key to the world's economic puzzle. Ready to unravel the mysteries of the global economy? Let's get started. Ever heard of the World Bank, but not quite sure what it does? Well, let's clear that up. The World Bank is like a global financial powerhouse. Its role is to lend a financial hand to low and middle-income countries, helping them fund capital programs. These programs could include anything from building infrastructure to improving education or healthcare. The primary goal of the World Bank is to reduce poverty and support development. How? By providing loans and grants to countries that need it the most. While a bank in your town might give you a loan to buy a house or start a business, the World Bank gives loans on a much larger scale. We're talking about billions of dollars to help countries develop their economies and improve living conditions for their people. But the World Bank doesn't just hand out money. It also offers advice and expertise to help countries manage their economic policies. The World Bank is a key player in shaping the global economic landscape. GDP, or gross domestic product, might sound complex, but it's simpler than you think. Now, imagine a country as a giant factory, and all the goods and services it produces are its output. The total value of this output, produced within the country's borders in a specific time period, usually a year, is what we call the gross domestic product. But why is GDP so important? Well, it's like the economic report card of a nation. It tells us about the size of the economy and how it's performing. If GDP is on the rise, the economy is in good shape. It means businesses are producing more, people are finding jobs, salaries are increasing. Conversely, if GDP is falling, the economy could be in trouble. So, in essence, GDP is a comprehensive measure of a nation's overall economic activity. It's a vital tool for economists, policymakers, and investors. GDP gives us a snapshot of a country's economic health. Debt isn't just about credit cards and loans, it's a crucial part of the global economy. You see, debt is a double-edged sword. On one hand, it allows countries to finance their operations, invest in infrastructures, and stimulate economic growth. Borrowing can be a strategic move, an investment in the future. Think of it this way: a country is a bit like a business. Just as a business might take on debt to invest in a promising new project, a country might borrow to fund a highway, a school, or a hospital, institutions that over time will enhance the well-being and productivity of its citizens. But like anything, too much of a good thing can be harmful. Excessive debt can lead to financial crises, especially if a country is unable to repay what it owes. It's a delicate balancing act, keeping the scales of borrowing and repayment in check. Debt, when managed properly, can be a tool for growth and development. Inflation is often called the invisible thief, but why? Well, let's unravel this economic mystery. Picture inflation as a rate, a percentage that describes how quickly the general level of prices for goods and services is rising. Now imagine you've stashed away $100 under your mattress. Over time, as inflation rises, that $100 won't buy you as much as it once could. That's because inflation erodes the purchasing power of money. It's like an invisible hand reaching into your pocket, taking away a little bit of your money's worth each time. It's subtle, you might not even notice at first. But over time, you'll start to feel the pinch. Your money is still there, but its value? That's been silently and steadily chipped away. So, the next time you hear about inflation rates, remember, it's more than just numbers on a screen. Inflation is a critical economic indicator that affects everyone. Economic growth is the goal of every country, but what exactly does it mean? Well, in its simplest form, economic growth refers to an increase in the production of goods and services over a certain period. Imagine a factory churning out more widgets this year than it did the previous one. That's economic growth happening right there. This growth is typically measured by the gross domestic product, or GDP, a term we discussed earlier. It represents the total value of everything produced within a country's borders. More widgets, higher GDP. But why is economic growth so important? It's because this growth directly impacts the quality of life. As a country's economy grows, it can invest more in education, healthcare, and infrastructure, lifting the general standard of living. More jobs are created, incomes rise, and poverty levels drop. So, you see, economic growth is not just about numbers, it's about people. Economic growth is the key to improving the standard of living in a country. So, there you have it. The basics of global economics simplified. We've journeyed through the enigmatic world of the World Bank, whose loans and advice drive economic policies worldwide. We've decoded the gross domestic product, or GDP, which provides a high-level snapshot of a country's economic health. We delved into the nature of debt, a double-edged sword that can stimulate growth or lead to economic calamity. Then we confronted the invisible thief of inflation, which can silently erode your purchasing power. And finally, we've explored the concept of economic growth, a key indicator of prosperity. Understanding these concepts is like assembling a jigsaw puzzle. Each piece, whether it's the World Bank, GDP, debt, inflation, or growth, fits together to form the bigger picture of the global economic landscape. And the more pieces we can identify and place, the clearer that picture becomes. Remember, every piece of this economic puzzle is interconnected, shaping the world economy as we know it.